Right now, the United States economy is operating with a massive blind spot. There is currently no federal law dictating what a digital asset actually is, or how it functions as a means of exchange. We are completely lacking the legal parameters needed to govern this space. This regulatory void has historically allowed bad actors to step in and exploit consumers. Without federal oversight, individuals have managed to hoard funds and mismanage deposits, leaving retail investors to pay the price for the lack of clear rules. The proposed solution to this chaos is the Clarity Act. This is a 616-page piece of legislation, forged over 11 exhausting months of 7 days a week bipartisan negotiation, to finally put those missing legal parameters on the books. Without these rules, digital finance remains a hazardous frontier. By establishing clear definitions, this bill sets the foundation for how the next century of global finance will be organized. But time is running out. The Senate is exactly 14 days away from their August recess, leaving lawmakers with a razor-thin window to line this up and lock in a floor vote. And right as the bill nears the finish line, a highly coordinated opposition campaign has launched a full-court press to stall it out. Legacy financial institutions have emerged as the primary opposition to the text. Major entities like JPMorgan Chase and Bank of America have mobilized a full-scale effort to prevent the bill from reaching a vote. This pushback puts the interest of the legacy banking sector in direct conflict with the proposed rules for digital finance, creating a high-stakes standoff on the Senate floor. The traditional banking sector is terrified of one specific thing: deposit flight. They are worried that legally protected DeFi lending platforms and high-yield stablecoins will incentivize people to pull their cash out of traditional community banks. Admitting to a fear of competition is a difficult public relations move for a bank. Instead, these institutions fund proxy organizations to carry their message to Washington. Legacy banks pay over $100,000 in corporate sponsorships to groups like the U.S. Hispanic Chamber of Commerce. In return, these proxy groups flood Washington with reports claiming digital assets accelerate deposit flight, even though independent studies debunked that. By quietly financing these front groups, legacy finance is purchasing the illusion of grassroots opposition to block a technological shift they simply cannot compete with. Back on the Senate floor, the math is brutal. Republicans largely support the Clarity Act, but to pass the bill in a divided chamber, they need at least 10 Democrats to cross the aisle. For lawmakers wanting to appease banks, voting no requires a cover story. They found their political shield by fixating on the bill's ethics provisions. But the authors of the bill have already made enormous concessions to satisfy those complaints. They included a strict ethics clause that specifically targets a single administration, set to sunset in 2029. They even added a provision allowing state-level attorneys general to enforce these federal ethics rules, a massive transfer of oversight rarely seen in Washington politics. Yet opponents continue to claim the bill falls short. When politicians keep moving the goalposts after receiving the exact concessions they asked for, they aren't negotiating in good faith. They are throwing up a smokescreen to run out the legislative clock for their banking donors. While politicians in Washington spend their time posturing, the global market is moving on without them. Corporate adoption is accelerating, ignoring the gridlock entirely. Just look at hardware giant Samsung. They recently dropped a massive announcement. They are integrating native stablecoins directly into their smartphones, enabling fast, trusted value transfers right from a mobile wallet. Samsung has developed this integration alongside established payment giants like Visa and Barclays, prioritizing native digital asset support in their core mobile experience. Mainstream corporations are already hardwiring digital assets into the devices we use every day. The political blockade in D.C. is fighting a reality that already exists. This chart illustrates the staggering scale of the shadow economy waiting for legal clarity. We are looking at an exponential spike, reaching over $360 trillion in stablecoin transactions already being processed globally. When you look closely, the transaction layers are heavily dominated by two networks, Ethereum in the blue and Solana in the purple. Now ask yourself what happens when the Clarity Act breaks the gridlock. Institutional capital has been waiting on the sidelines for strict legal definitions before they can interact with these dominant networks. Once that regulatory certainty arrives, the market is positioned for a vertical, explosive surge, a god candle that outpaces historical trends simply because the legal floodgates have opened. the traditional banking sector is fighting to hold back a shift that is already well underway. By removing the legal risk for large-scale investors, the Clarity Act provides the missing link between traditional capital and these growing digital networks.